Every single day, more than $6 trillion changes hands. 6 trillion. That is more money than most countries produce in an entire year, moving silently through a market with no central exchange, no physical floor, no closing bell. And yet, according to regulatory disclosures required across major financial markets, a significant majority of retail traders who enter this market, figures frequently cited range from 70 to 80%, lose money over sustained periods, not occasionally, consistently, across countries, across years, across platforms. The numbers don't lie. The question is, why? Before this is over, you will understand exactly how the structure of this market was engineered, who sits at the top of it, and why one of the largest financial fraud cases of the 21st century was hiding in plain sight for years inside the world's most trusted banks. The answer involves something called the fix. And once you understand what that phrase really means, you will never look at a currency quote the same way again. The foreign exchange market, forex, operates 24 hours a day, 5 days a week, stretching across every time zone on the planet. According to the Bank for International Settlements Triennial Central Bank Survey, daily FX turnover reached approximately $7.5 trillion in 2022, making it widely recognized as the largest financial market in the world by daily trading volume. And unlike stocks, it has almost no central oversight. Trades happen between banks, brokers, and institutions in what is called the over-the-counter market. There is no tape. There is no single record of every transaction. It is, in many ways, a dark ocean. Retail traders, ordinary people sitting at laptops in apartments in London, Lagos, Manila, and São Paulo, enter this ocean believing the same story, that with the right strategy, the right indicator, the right discipline, they can carve out a consistent profit. Trading courses sell this dream. Influencers build entire brands around it. But here is where it gets interesting. The entities on the other side of every retail trade are not other retail traders. They are market makers. Often the same major banks whose currency desks handle billions of dollars in institutional flow every single day. When a retail trader loses, that loss does not disappear. It transfers. And for years, evidence was building that those transfers were not entirely the result of a fair market. In 2014, regulators on both sides of the Atlantic began announcing settlements that would eventually total billions of dollars in fines, with published figures across the named institutions running into the multiple billions according to regulatory announcements from the U.S. Department of Justice and the Financial Conduct Authority. Barclays, Citigroup, JPMorgan Chase, UBS, the Royal Bank of Scotland, and HSBC were all implicated. Traders inside these institutions had been communicating through private online chat rooms with names like the Cartel and the Bandits Club. Inside these rooms, they coordinated their trading activity around a specific 60-second window every day, 4 p.m. London time, known as the fix. This was the moment when benchmark currency rates were set, the rates that corporations, pension funds, and investors around the world used to value their holdings. And it had been manipulated. Think about what that means. The reference point that the entire global financial system relied on for accurate currency pricing was, for an extended period, being shaped by a group of traders in a private chat room. The benchmark was the market, and the market had a back channel. Remember what was said at the start. 70 to 80% of retail traders lose money. That statistic is usually explained away with talk of poor discipline, over-leveraging, emotional decision-making. And those things are real, but they are not the whole picture. When the infrastructure of price discovery itself carries documented instances of coordination, as regulators in the United States and United Kingdom formally concluded, it raises serious questions about the fairness of the broader market environment in which all participants, including retail traders, were operating. Since the settlements, regulators have pushed for reform. New guidelines around the fix were introduced. Surveillance systems inside banks were upgraded. Traders were fired, fined, and in some cases criminally charged. The Financial Conduct Authority in the United Kingdom and the Department of Justice in the United States both described the conduct as a serious breach of the most fundamental standards. The forex market today operates largely the same way it always has. Over the counter. Decentralized. Massive. The same banks that paid those fines remain among the primary liquidity providers for the brokers that retail traders use every day. Regulators introduced new guidelines and surveillance requirements following the settlements, though critics and market observers have continued to debate whether structural reforms went far enough to address the underlying conditions that allowed the misconduct to occur. So we return to where this began. $6 trillion a day, 70 to 80% of retail participants losing, a decade-long manipulation scandal inside the world's most powerful financial institutions, all documented, all real, all quietly absorbed into the footnotes of financial history. The fix was exposed, the fines were paid, the chat rooms went dark. But here is the question nobody has fully answered. In a market this large, this opaque, and this consequential for ordinary people around the world, the settlements raised a question that regulators, academics, and market participants continue to debate: whether the reforms that followed were sufficient to match the scale of what was uncovered. This video is for educational and entertainment purposes only and does not constitute financial, legal, or investment advice. Always do your own research before making any financial decisions.